Good day, empowered investors. Greetings from New Orleans. I am just leaving the New Orleans Investment Conference today. Spent a couple of great days here, hung out with Peter Schiff, Robert Kiyosaki, Brent Johnson, David Collum. All these people have been on the show before, Adam Taggart, a whole bunch of others. Anyway, it's been a great time, and now I am headed back home. But, again, I want to point out that I am not really a real estate investor. Nope. I've said this for 21 years, and you are probably not really a real estate investor either. You are a packaged commodities investor. This is a commodities-oriented conference, so think about it. When you buy commodities in any other way except as a packaged commodity with a real estate or house label on them, you are not getting the multidimensional, incredible, beautiful aspects of a real estate investment. Most importantly, that 30-year fixed rate government subsidized mortgage that is the trademark, the hallmark of great American real estate deals. So be a packaged commodities investor rather than an investor just buying things on the commodities exchange or from some commodities person or broker. Okay, let's get into it. So always ask yourself, what are they not telling you? Always when someone presents something, always when someone presents a chart, an article, says something to you, whatever, always say, what are they not telling me? So this says, the Hamptons luxury housing market, the Hamptons, New York area, right? The Hamptons luxury housing market is staging a comeback for the ages. Home sales priced at $10 million or above, the volume has gone way up. Almost 100 home sales, $10 million or above. And this chart is comparing the last 10 years. And the numbers are higher now. But what is it not telling us? Well, it's not adjusted for inflation. So $10 million is really $7.3 million because the dollar has lost that much value in the 10-year period outlined in the chart. So do you see how misleading this is? The dollar is a moving target. That number is moving around. So when someone tells you that home sales are skyrocketing at these higher values, well, are they really? Or are those really $7.3 million? Or are they $10 million? You've always got to adjust for inflation. And remember, this is understated because this is based on the CPI, the Consumer Price Index, the CPI, which is a lie, the CPI. And that is very, very misleading. When you see that it's really $7.3 million in today's dollars, right? Then you start to see the reality isn't as extreme as the Wall Street Journal would like you to believe. And that's where the chart is from, the Wall Street Journal. So just to comment on that. But here is the analysis of it, okay? So $10,003, right? Or $10,003,670.62 equals 7.3 million of buying power, okay? And that is the important thing to understand. You can adjust inflation in either direction, right? It doesn't matter, but the thing that matters is that you understand, well, it does matter slightly because it depends what number you're coming from. I'm not a mathematician, but you get the idea, okay? But, the basic idea is close enough for government work. And when you adjust for inflation, the story becomes much more clear. Okay, now here, luxury home price growth outperforming non-luxury. This is a rarity, folks. This is a rarity. But what it shows us is that the concentration of wealth is getting bigger and bigger and bigger, and we are living in a mass affluent society thanks to the Cantillon effect. Remember that economist I've talked about many times over the years, that the people closest to the money printer get the biggest benefits of the money printing? And we have had historic money printing, Great Recession, COVID, Biden administration, right, et cetera, right? We have had just a massive increase in money creation and quantitative easing, where the Federal Reserve is getting into markets and buying up assets to make the prices of them go up and make the money supply looser and easier. And so that has consolidated at the top of the market. And I don't mean the real estate market per se, I mean every market, where the rich just keep getting so much richer. It is completely unfair. It is terrible, but it is what it is, and we have what we have. Remember, one of the steps to mastery in life is have what you have. It's an acceptance of what is going on, and then use my techniques to game the system and win the game, okay? So that is the thing. So luxury home prices, right? They've grown 4.8%, and non-luxury home prices only 1.8%. That is so unusual. It is very, very unusual. This is year-over-year change in median home price for luxury versus non-luxury. That is extremely unusual. Usually, the lower end of the market is going to appreciate more. That's the normal thing that we would have seen any time in the last 50, 60 years. But now, that is flipping a bit because of the concentration of wealth at the top of the market. It won't always be that way. Probably next year or the year after, this equation will flip again. And then it will be the lower end, the entry-level homes appreciating more than the high-end homes. But remember, as this happens, don't make the mistake that so many economists and forecasters make, and it is a huge mistake. Don't make the mistake of thinking that it is the same tenant renting the same house or the same buyer buying the same house. What happens when you have this type of consolidation of wealth at the top, right? This winner-take-all society that we live in, what you have is you have people falling down the socioeconomic ladder and accepting less and capitulating. Again, economists just don't understand this. They don't say it, but it's what really happens in practice. Every market actor, you, me, everybody else, we go into the marketplace to buy what we want to buy, a house, a car, whatever it is, and we look around and we try to strike the best deal we can get, and we accept less than our expectations most of the time, right? Our expectations are usually in the clouds, and what we accept is usually less than that, almost always. So that's just the way it works, okay? All right, luxury home inventory has climbed, but prices have gone up more than the low-end inventory, which is also a very interesting, unusual thing, right? So the number of luxury homes climbed 7.7% year over year to the highest September level since 2020. Non-luxury inventory rose 11.4% to the highest inventory level since September of 2019. So one before COVID and the other after COVID started. So that is kind of interesting, but again, the overall inventory stats are still very low historically. Higher than they've been, sure, but not a big deal. Not a big deal at all yet. Okay, so that is the same chart. Okay, now here is another interesting thing that shows what is happening with the economy, right? International tourist trips by region of departure. Okay, and it just shows you who's coming to places, who's leaving places, who has money, who doesn't. So this was much higher pre-COVID, and then of course it went to almost nothing during the COVID era where travel went down the tubes. And it has come back for sure, but again, not back to the prior levels as we start to see more and more people at the lower end of the spectrum, or the middle to lower end, struggling more and more. And what does that mean for you? That means there's going to be more upward pressure on rent prices. I know that rents have been boring, muted, a little bit soft for the past couple of years, but there is a lot of factors pointing to increased rents in the very near future, mostly again due to record number of apartment deliveries over the last couple of years. And that is all being absorbed, and once that's absorbed, we're going to see rents tick up quite a bit. There's a lot of upward pressure on rents. I'm seeing it early. Most people aren't seeing this yet, but it's there, okay? So it is coming. Now, this is interesting too. A chart from Statista talking about US home prices are up 29% since 2019. What's interesting about this is that there are many surveys that would tell you prices are up almost 50%, okay? It kind of depends what survey you look at so much of the time, right? But the interesting thing is that the linear markets on the whole had the highest appreciation, leading with Knoxville, Tennessee at 60%. Charleston, North Carolina. By the way, these are both markets we've recommended over the years, okay? Charleston, North Carolina, 52.4%. And then my old home, South Florida, right? Miami, Fort Lauderdale, West Palm Beach, 49.1%, not a linear market, okay? The other two are linear. That one is cyclical. Syracuse, New York, more linear. Tucson, Arizona, linear. Columbia, South Carolina, we've been in that market too. Cleveland, Ohio, we've been there. Tulsa, we've been there. Recommending properties. Many of our clients have purchased in many of these markets over many, many years. So these linear markets on the whole are outperforming the high-flying cyclical markets. At the bottom of this list is San Francisco at 1.7%. Now, San Francisco's had some unique problems, right? This once beautiful city that has turned into a big government disaster. And with the elections yesterday, wow. I mean, two old sayings. Number one, people get the government they deserve. And number two, never overestimate the intelligence of the electorate. Okay, it's sad. But you know, look at people go for instant gratification. It's just human nature. Whoever is giving out the goodies is who they're usually going to vote for. People vote their pocketbook. Okay, that's just the way it works, unfortunately. And what that means for us is it means government intervention in the markets, which causes shortages, always and forever. Shortages, shortages, shortages. And if you own the asset that is in short supply, you are going to win the game. The other thing about that is that all of this leads to more and more inflation. And if you're following my strategy, inflation-induced debt destruction, you are also going to win the game. You're going to win the game multiple ways. So good for you. Happy investing. House prices outpaced income growth over the last 40 years. Now, this kind of data is not very accurate in some ways because a couple of years ago when we had the low COVID era interest rates, house prices, you know, just look at the chart, were outpacing income like crazy, but because the rates were low, houses were actually very affordable at a time before we saw the big price increases and then the subsequent interest rate increases, which just made it completely unaffordable. But always remember, income property is a multidimensional asset. If you've listened to my piece that I call the 3 dimensions of real estate, you know that all you have to do is adjust your strategy along the way. Sometimes you're in a capital appreciation market where house prices are going through the roof and you're making tons of money. You can execute my refi to die strategy. You can execute my 2 or 3 for 1 exchange, 1031 exchange strategy, and you will win the game. Sometimes prices are cool and rents are going up. It's always going to ultimately be one or the other. Always remember, when I was on stage yesterday here at the New Orleans Investment Conference, I talked about how income property, just like every business, every corporation, income property, because it is a business, income property is a pass-through asset. So when owners' expenses go up, rents go up. It has to happen. Nothing else can ultimately happen. Now, it does take a little time for this to play out because those expenses can go up. And someone asked about insurance, and you know, if you don't own an older house in Florida, your insurance really hasn't been a big deal, okay, if you've got a newer property, right? But if you've got an older house that was built, you know, decades ago, Florida insurance went through the roof, and that's what the media reported on. And I talked in detail about my insurance on my own Florida properties and how, as a percentage, It was significant, but as a dollar amount, it didn't even move the needle. When the insurance goes up $500 a year, so what, right? It's just not even worth worrying about. But that ultimately passes through to the tenant. It always does. So always know that, you see minimum wage go up and suddenly all the restaurants increase their prices. And that's just the way it is in every business with every property. It's always a pass-through entity, and all of that gets passed through to the customer or the tenant or the renter in terms of inflation. Restaurant prices, rents, whatever, doesn't matter. Okay, so we have lower rates, thank God. Rates are really, really coming down. And I know on a day-to-day, week-to-week basis, there may be ups and down blips, okay? The Fed does not control the mortgage rate directly. It is heavily influenced by the 10-year, but there's more to it than just the Fed. It depends on asset purchases and bond sales and all of this stuff, right? Treasuries, et cetera. But overall, the trend is lower rates, which is going to mean higher prices when you put the explosive nature of lower rates into a limited inventory market. It can't do anything else. You're gonna see higher prices. So get ready for a much more stabilized market coming forward. Packaged commodities investing. I saw this article and I just thought it was interesting because once again, it speaks to my strategy. When you buy a property, you're really buying the ingredients of the property. When you buy a house, you're buying copper wire in the walls, petroleum products, lumber, glass, steel, labor, concrete, all these packaged commodities. And when the prices of those commodities that have universal need all around the world, not attached to any one currency, every human needs them because every human needs shelter and all kinds of other things, you are going to win the game, but you get to finance them with a 30-year mortgage on the most tax-favored asset class in America. There are just so many incredible, wonderful things. So when Bank of America has an article that says copper could rise up to $15,000 per ton, a huge increase, that's just going to make all of your rental properties more and more valuable. So congratulations, be a packaged commodities investor. All right, so next up, I want to play a short interview that I did about a subject that is probably going to affect all of us and something we should consider. I talk a lot about the Die with Zero book, right? And how we should use our money to enjoy our wealth once we've made it, right? This does not apply to beginners. You've got to create your wealth, and I'm going to help you do that. But once you create it, don't forget to enjoy it. And one of the concerns that so many people have with this strategy is the idea that you might have too much life at the end of the money. And this is going to be a problem for millions and millions of people because we are on the verge of so many longevity breakthroughs. Check out my longevity and biohacking podcast for more on this. There are just so many amazing things going on. But one of the things with this is long-term care insurance. Now, I have no affiliation with this or anything, but I just wanted to share this short interview I did because it's a topic we all should consider and should think about. Most people are kind of like, well, I don't want to say most people, but most people with some money and means, they're kind of overinsured and they've spent too much money on this stuff. But some people aren't paying any attention to it. But it answers the objection of outspending, outliving your money, okay? And that's why I wanted to just share this short interview I did fairly recently about long-term care insurance. No affiliation with us, we don't make any money off this or anything like that, but I just wanted to share it. In the meantime, if you need help with your investments, reach out to our investment counselors. We are all here to help you on your journey of wealth creation. Go to jasonhartman.com. Fill out any web form, we'll get in touch. Be sure to use our free AI tool at jasonhartman.com/AI, or you can just find it on the front page of jasonhartman.com too. And it is trained on thousands of episodes of my podcast, my YouTube channel. You can ask it any question under the sun, and you will not believe how smart it is. Yes? I soon will be out of a job too, because I'll be replaced by AI. Anyway, check that out, jasonhartman.com. It's the little superhero in the lower right side of the webpage at jasonhartman.com. use that. Those of you who do use it, keep coming back week after week and using it multiple times a week, sometimes multiple times a day, and you're getting tons of answers, you're proposing scenarios to it, and just getting all kinds of data on all of my techniques and strategies that I've been teaching for the last 21 years. So take advantage of that. It's totally free, no strings attached. It's great. We've got our property page on there. We are working on training the AI tool we have, my clone, essentially, on all of our properties that are available. And we haven't quite figured that out yet, but we are working on it. And now you have to look at the properties manually, but you can get all the techniques from the AI, from the chatbot, and you can talk to it on your phone with your voice, or you can type. Either way.